guys. Good afternoon. Good afternoon. It's your girl Folasade, the accountability accountant, guys. I haven't been with you guys in literally 2 weeks. I didn't disappeared, ran away. Don't even really want to come back for real, honestly. But I'm excited to be back with you guys on this amazing Tuesday. Honestly, it felt like a Wednesday to me. But I will be live tonight on the Money Zone on a whole totally different topic, guys. But on today's topic, we're going to talk about all of these tax strategies, such as the Augusta Rule, the Cohen Rule, and basically answer any of you guys' questions. Okay, so let's go ahead and first, I'm gonna start. Let me go and do a TikTok search first. So we could go ahead on and look at what's happening right now. Give me 1 second, Cohen Rule on TikTok. Should have had that ready because I knew I wanted to show you guys that. Hold on. Cohen Rule. Did I even spell it right? I don't even know. Wait, man. Tender. Okay, so guys, if you're just coming in right now, what we're about to do is go over some of these tax strategies and things that you guys have learned from online, and a lot of you guys are trying to incorporate these tax strategies on your taxes, Cohen Rule. And what I'm finding is that I'm gonna be really honest with you. It just seemed like the moment that Black people implement things such as the housing market, the no-doc loans during the housing market, the PPP loans, SBA programs, they've making changes to it. And then lo and behold, guess what? The Augusta Rule and the Cohen Rule is being highly, highly, highly scrutinized right now. So we're going to talk about it, okay? But before we go into that, let me explain to you guys what the Cohen Rule is, okay? So we can all be on the same page. And if you guys want to see my screen, head over to my YouTube channel, which is Folasade TV, if you want to see my screen, okay? And the reason why I'm talking about this is because, tax season is right around the corner, guys. And many of you, you're new to following me, which I think I do a really good job of being extremely forthcoming with the truth about all of these tax strategies and all of these tax deductions, not trying to lure you guys in just so I could do your taxes or just so you can work with me by doing shady content. But I'm finding that when I do content straightforward, straight up, no chaser, telling you guys the blatant truth on how to implement it, it goes unseen and unheard. But these TikTokers, they come and all of these fake, they CPAs and stuff, all these CPAs and all these people that's out there putting out bad content, they're telling you guys half of the truth. You're following them. I don't know if you're moving forward working with them. I'm not concerned about that. But if you're following them and you're trying to implement these tax strategies without the full nuances or without all of the full intricacies behind implementing these tax strategies, is where I'm getting frustrated from. So let's go ahead and do a deep dive, first of all, into the Cohen Rule. So the Cohen Rule, guys, basically say the Cohen Rule is, under the Cohen Rule, taxpayers, when unable to produce records of actual expenditures, may rely on reasonable estimates provided there is some factual basis for it. The rule allows taxpayers to claim certain tax deductions on the basis of such just estimates, okay? Oh, thank you. Just estimates, okay? So basically, in layman's term, and not reading it from the screen, the Cohen Rule basically says this: if you were to get audited, or you have to go to tax court, and you don't have all of your receipts for the expenses that you claimed on your tax return, guys, right? You are then able to make estimates, okay? So I know you guys have seen the Cohen Rule online. I'm trying to find some of the TikToks, okay? Give me a second. Or did TikTok ban it where you can't? Oh, I think I got to go to TikTok.com and then maybe search. Give me 1 second, guys. And then I don't even have my TikTok login. Am I logged? Gosh, why is it making noise? Come on, TikTok, you about to mess me up, man. Why is it trying to make me sign in? Guys, I'm gonna have to sign in. What is my TikTok login? Oh gosh. Let me see if it'll come through my phone. Okay, guys, give me 1 second. I'm trying to select 2 objects that are the same shape. I'm trying to log into my TikTok account so I can verify, so I can bring up some videos that's discussing this Cohen rule so we can talk about it. I should have did this before, but look, I just said, let me go live. 6. I said, let me go live, then we'll figure it out together. Okay, I'm in. All right, I'm in, y'all. I'm in my TikTok block. I'm in my TikTok. Yay. Okay, so now I can search the Cohen rule. Okay, so I'm about to share my screen, guys. Once again, if you want to see my screen, head over to our YouTube channel. We are still attempting, well, I'm always trying to grow all my platforms. Alrighty, so we're about to share this Cohen rule.
In an audit. There's a rule called the what do I do if I don't have proof of my expenses in an audit? There's a rule called the Cohan Rule, which allows you to make estimates on those expenses. For instance, mileage. You didn't track your mileage, but you know that you drove around. Maybe you're a real estate agent and you went ahead and you took clients to different houses. You know you incurred that expense. The Cohan Rule allows you to recreate those expenses on a log. What do I do if I don't have?
Hi, I'm Lauren Cohen, and you are behind the scenes.
I put on a black wig.
All right, so that was one. Let me see if I can find another video. I really want to find one of them black accountants because I'm black, honestly. I think I just want to find one of them. So just give me a second, guys. I'm still finding some more videos that's talking about it. Cohen rule. Oh, you know what I'm finding too? That now, I don't know if they're removing this stuff off of the internet or whatever, but I'm starting to think that maybe TikTok is starting to be aware of what's happening with all of these tax strategies, because I literally cannot find it. And if I wasn't looking for these people videos, this is pitiful. If I wasn't looking for these people videos, I would be able to find them because they come on my screen every time. But let me go back and let me just stop sharing, and then so we can go over what that lady said. So first things first, guys, let me show that video one more time because we did find one, so we can put some context to it again. Okay, so I'm gonna share that, and then I'm about to dive into it. Let me share it again. And then I'm going to do a deep dive into it because
my expenses in an audit. There's a rule. What do I do if I don't have proof of my expenses in an audit? There's a rule called the Cohan Rule, which allows you to make estimates on those expenses. For instance, mileage. You didn't track your mileage, but you know that you drove around. Maybe you're a real estate agent and you went ahead and you took clients to different houses. You know you incurred that expense. The Cohan Rule allows you to recreate those expenses on a log. What do I do if I don't have proof of my expenses in an audit? There's a rule called the Cohan Rule, which allows you to make...
Somebody share that one, okay? And everything is fair use, fair use, fair use. I forgot to say that before y'all be trying to get my little video taken down with my little bit of followers. Don't worry about me now. Fair use, guys. So I'm about to play this.
To reconstruct your records based upon a reasonable data that you provide to us. Okay. We can reconstruct your records and file a return, and the courts have said that's allowable, even if you have no records.
You can actually use estimates.
You can actually use, and that's the beautiful thing, they allow you to use estimates based upon a reasonable basis.
So what about my mileage and maybe my entertainment expenses?
Mileage is low. Entertainment, no. That's not.
Cohan doesn't work.
Cohan doesn't work that way for mileage.
Just don't want to
entertainment.
mislead anybody.
Don't want to
who's
mislead
watching.
you.
You cannot use the Cohan rule
No,
for
not allowed.
entertainment. You can't use it for mileage,
Right.
that sort of thing.
Okay, now you see this video, guys, that we're watching right now. The guy said, oh no, you can't use the Cohan rule for mileage. But in that other TikTok video, that lady said, oh, if you don't have your mileage, you can do an estimate. You can use the Cohan rule for it. Guys, that is not true. You cannot. So the guy here on the YouTube video was actually right. You cannot use the Cohan rule for all expenses. So all of these TikTokers keep telling you guys, oh, they're not telling you what I'm telling you guys, which is to do your bookkeeping so we can track all of your expenses. Okay. No, what they're telling you is, oh yeah, there's a tax strategy called the Cohan rule, and it allows you to take estimates on your expenses and things like that. Okay, guys. So yes, we can take reasonable estimates to file your tax return. Okay. That's true. If you were to get audited by the IRS can then, the agent can then accept estimates or decline to accept your estimates. If you go to tax court, the judge can also decline those estimates using the Cohan rule. So you guys going off these TikTok videos saying, oh, you could just take estimates and all of those things is not true. It's partially true. And remember, anything that's partially true is still a lie because you're not telling the full truth. So the full truth is this, guys. The Cohan rule can be used in certain situations, but there's still a lot of expenses that you cannot use the Cohan rule for, okay? Number one, auto expenses. You cannot use the Cohan rule for your mileage, for your auto expenses, for your auto insurance, okay? And your repairs and all of those things. You actually have to have the actual proof to substantiate that expense, okay? Your gifts. If you give clients gifts, you cannot use the Cohan rule for gift expenses, okay? Entertainment is no longer an expense right now due to the Tax Cuts and Jobs Act. So you cannot use the Cohan rule for that. And it was one more. Oh, what is this one? Hold on. What's my note say? Y'all, I got horrible handwriting. What's my other one? Oh, meals. You cannot use the Cohan rule for meals. And you cannot use the Cohan rule for travel. I'm going to repeat that. For all of these TikTokers that is telling you guys that you don't need to worry about bookkeeping, like I emphasize, okay? They're telling you, oh, you can just use the Cohan rule and take estimates. But that doesn't work for all expenses. According to section 267 of the Internal Revenue Code, you cannot take estimates for travel, meals, gifts, auto expenses, and you can no longer deduct entertainment. So the Cohan rule, guys, does not apply across the board. Put one in the chat if you fully understand what I'm trying to say right now. Put one in the chat if you're with me, if we're on the same page, or do I need to go even deeper? One in the chat, guys, let me know if you understand what I mean. By number one, estimates using the Cohan rule is not going to work. There was a recent tax court case where the Cohan rule, now it's actually going to come precedence and use for future tax cases. Perfect. So now with this recent tax court case that just got published, right? The judge didn't allow the Mulligan rule, or which allows you to use the Cohan rule. The judge didn't approve it. So all of these false so-called influencers telling you guys, oh, take the Cohan rule, do this, do that. They're not telling you that the judge have to be willing to do it. They're not telling you that the IRS agent can decline to accept estimates, especially when you cannot prove a reasonable basis. I'm going to repeat that again. I prefer for you guys to just do your bookkeeping. The bookkeeping is the process of accumulating all of your income and all of your business expenses. The moment you do your bookkeeping, guys, you don't have to worry about using frivolous Cohan rule to win your tax court cases or your tax audits because you have effective bookkeeping in place. The Cohan rule should only be used in situations like, let's say, for example, and God forbid this ever happen, right? So let's say, for example, your office burned down and you don't have all your records, but they know you have an office space, okay? Because what business in your industry don't have a location? So they give them reasonable basis. And then because they see your lease agreement, okay, and you're able to show that you paid XYZ, but you don't have the full amount, because you have a reasonable basis, because it aligns with your industry, they will accept your rent expense under the Cohan rule, okay? They'll accept that. But they're not going to accept your mileage and your auto expenses and your meals and your travel and stuff, guys. You need bookkeeping, guys. It is imperative. Remember, according to the School of Wharton, guys, give me 1 second because my computer about to die. According to the School of Wharton, accounting is the language of business. So if you guys are not doing your bookkeeping, you don't know business. You don't know your business. Okay, so Instagram says, if you have a garage full of personal items and turn them into a small business to pay bills, but you don't have receipts anymore, do you have to pay full tax? So in your case, you will have to do estimates as reasonably as possible to get the actual cost that you incurred for those individual items, okay? And then you will file your tax return in that case. Okay. All right, guys. So the Cohan rule. Do we have any questions at all about the Cohan rule? And I'm gonna show you guys a recent tax court case. And this is why it's no shortcuts to success, guys. It is no shortcut to success. And you don't even want to take shortcuts because it backfires. You have sleepless nights. But what I'm finding is because you guys don't want to do your bookkeeping, you're falling prey to all of these accountants and influencers and coaches that say you can write off everything, okay? And then guess what? You're the one who have to fight that in tax court, because the reality is all of these people that's saying this stuff, guys, I know they've never defended anybody in tax court. I know they never defended anybody in a tax audit. I know that they've never experienced the IRS throwing out expenses and having to back it up. Okay, guys. So any questions about the Cohan rule? Okay, so the next thing I'm going to talk about is the hire your child, okay? So the next thing we're going to talk about is hiring your child, guys. So I'm first going to show you this video from the Black Enterprise, right? Remember, I keep telling you guys, all this tax advice that's out there, you cannot take it off the basis of what these people
business, and you can actually pay them $13,850 in 2023, and they pay no taxes. Better yet, you get a tax deduction for doing that. Even more so, if you are the only owner in that business, you're a sole proprietor or an LLC, sole member LLC, you don't even have to pay payroll taxes, neither you or the child. Now, here's where it becomes significantly important. You can now, because your child has earned income, you can now take $6,500 that nobody paid taxes on, put that $6,500 into a Roth IRA, and that money grows tax-free forever. Now, if you put $6,500 in a Roth IRA for a 14-year-old child, and that money grows, let's say at the rate of the S&P 500, right? 9, 10%, whatever the S&P's done historically. By the time that child is 60, they have well over $1 million, and it's all tax-free. And that was a one-time contribution of $6,500. So think about how hard you had to work to accumulate $1 million. Let's think about that. And you could make a gift, right? Not a gift. You put your child to work. They make earned income. They make a Roth contribution of $6,000, and they got $1 million waiting for them when they turn 60. Think if you did that every single year. You can hire your children into your business, and you can actually pay them $13,850 in 2023, and they pay no taxes. Better yet, you get a tax deduction for doing that. Even more so, if you are the only owner in that business, you're a sole proprietor or an LLC, sole member LLC, you don't even have to pay payroll taxes, neither you or the child. Now, here's where it becomes significantly important. You can now, because your child has earned income, you can now take $6,500 that nobody paid taxes on, put that $6,500 into a Roth IRA, and that money grows tax-free forever. Now, if you put $6,500 in a Roth
All right, guys. So that's on Black Enterprise, right? So the guy said, oh, you can hire your child. That is correct. You can hire your child, okay? When he did the video, he said the standard deduction was $13,650. At that time, that was correct. Right now, in 2024, if you guys were to go and hire your child, you can pay them up to $14,000, okay? Now, here's where the problem comes with that hire your child tax strategy that a lot of you guys are trying to implement incorrectly. What you're doing is you're flat out just paying them that $13,000 or that $14,000. That is illegal. Your children are supposed to be bona fide employees of your company. So whatever your other employees have to sign to work with your company is the same thing your child will have to sign to work for your company. Your child actually need a real position in your business, okay? You also have to file payroll reports. You also need to issue them a W-2, okay? You also need to process payroll, even if no taxes are being withdrawn. Also, you cannot just pay them $13,000 and think that that's a write-off. It is not. Would you pay an employee just $13,000 and let them walk off and go? No. You're going to track their hours. You're going to make sure they're doing work. You're going to make sure they assign tasks. So you have to do the same thing for your employees. You have to do the same thing for your kids if they so-called are your employees. So yes, hiring your child does have significant benefits, guys. And yes, I was the first one that mentioned this in 2016, okay? And I went to try to find my, every time I'm trying to show you guys something, I can never find it, but I'll bring it and I'll do a screenshot because I just saw it on my page yesterday. One of my memories from yesterday. So how do you get memories from the day before on Facebook? I don't know, but yesterday's memories on Facebook was my Hire Your Child marketing that came out. Nobody was teaching Black people how to hire their child in 2016, 2017, 2018, 2019, 2020. I bought it back in 2020, and then that's when COVID, the pandemic, and all of these coaches that now lured you guys to hire your child. My concern is, did you guys do it correctly? Did you guys hire them? Are you tracking their hours? Are you paying? Are you filing the payroll reports? And I know this. I bet you guys didn't file no payroll reports. Did you file the 941s? Did you file the 940? Did you issue W-2s? If you didn't issue W-2s based on the tax court case that we're going to discuss, that hiring your child didn't fly. But if you guys took my Hire Your Child class, my master class that I taught, you would have known that. You wouldn't have fell for all of these posts on social media talking about hire your child, no paperwork, no nothing. They lied to you guys. But you are the one that have to sit with that problem. And that is my biggest concern. A lot of you guys, you're going to get audited over the next 2 to 3 years. And you're going to get audited for the following tax deductions and expenses and things that you guys took, which is number 1, that Augusta Rule. Number 2, you're making estimates relying on the Cohan Rule. Number 3, you're taking all of these auto expenses, right? And then last but not least, the hiring your child. You have to do it correctly, guys. Even if you hire a professional like myself, and I tell you guys, step 1, step 2, step 3, step 4, and you do step 1, 2, 3, and you don't do 4, that's grounds for it to be thrown out. One of the recent tax court cases, the IRS threw out that hire your child thing because guess what? The owner didn't issue W-2s. How is that person a real employee if you don't issue them a W-2, y'all? So put 1 in the chat if you guys understand a bit more about this hire your child tax strategy. Put 1 in the chat if you understand a little bit more in depth about this hire your child tax strategy. And if you don't know, go to my link tree. You will see I have a free freemium there about hiring your child. 1 in the chat, guys, if you now understand a little bit more about this hiring your child. Okay, we're getting some 1s, guys. We're getting some 1s. So are we clear? You need paperwork. Are we clear that you need to issue W-2s? Are we clear you actually need to run payroll? And are we clear just paying your child $13,650 or $14,000, which is the 2024 standard deduction, right? It's not sufficient. Are we all clear on that? Put 1 in the chat for me before I go to the next thing. All right, guys. So the next thing, the tax strategy I'm going to talk about now is this Augusta Rule. Okay, so let me Google it first. I'm going to read it from there, and then I'm going to explain to you guys exactly what it really is. Okay, give me a second. Hold on, let me see if I got it. And see what's so bad, guys. I personally, I'm going to be really honest with you guys. I have a lot of these people, like I can literally go to like 3 accountants' Instagrams and show you guys all of the nonsense that they're talking about regarding these strategies. And I can blow them up and all of that stuff, but I don't deal with drama. And I don't deal with people commenting on my content. So I don't go to those people pages and bash them and say, oh, you're not telling the people right, or trying to speak of these people's names in my live streams, simply because I'm not going to be fighting on Instagram and Facebook for you guys to really know the truth. If you really want to know the truth, you will pay attention to what I'm saying, invest in some of my courses, okay? And then you will know the full truth. You will also invest in your own accountant, guys. I cannot stress that. Taking advice, even from me online, I'm not your accountant. If you don't work with me one-on-one, if you don't call my office and Keisha pick up and get you on my calendar and you retain me as your accountant, I still cannot give you the full strategy. But I try to be as honest as possible when I give you guys tax tips. But it feel like y'all just want to be baited in. Y'all don't want us to tell you the truth. So here we go. It says the Augusta Rule, known to the IRS as Section 280A, allows homeowners to rent out their home for up to 14 days per year without needing to report the rental income on their individual tax return. I'm going to read it one more time. The Augusta Rule, known to the IRS as Section 280A, allows homeowners to rent out their home for up to 14 days per year without needing to report the rental income on their individual tax return. Guys, the strategy is beautiful, right? So the strategy basically says, okay, your business can rent your home for business purposes. You make the money. You don't have to pay taxes on that money, and your business can also get a write-off. Beautiful, right? Amazing. The best, right? But guess what? It's not that easy, guys. It sounds good. Hey guys, do you know that there's a tax strategy where you can rent out your home to your business and don't have to pay taxes on that income? Like, it sounds like a very good marketing campaign, right? It sounds very amazing. Everybody want to do it, right? But guess what? It's not that easy. It's not that easy, number one, because you guys don't want to keep the proper paperwork. So you don't have everything that you need to be able to back up that expense for your business. Problem number one. And because you guys have gotten caught up with having all of these LLCs, you have an LLC, you have an LLC, you have an S Corp, you have a partnership. I'm being funny, guys. But basically, because you guys have all of these LLCs and all this stuff, you're still not doing it right. And that's probably why they told you to do it. Also, you can have this as a managing company, have this as a marketing services, or whatever they're telling you guys to do. I'm starting to get lost with you guys, honestly. But that's not really, it's not an easy strategy to pull off. Okay. So number one, the issue coming to place is that many of you are trying to implement the Augusta Rule on rental property. It doesn't work like that. The Augusta Rule works on your primary residence. See, think about it. The moment that you try to do the Augusta Rule on your rental is already a business activity. So do you think the IRS will allow you to deduct income from a legitimate business activity? They will not. So the Augusta Rule works when it's your primary residence. So let's say, for example, you own your business. And yes, you need to utilize an office space to conduct business meetings or staff meetings, team meetings, things like that. Yes, you can rent your home to your business. But the issue is that home should not be generating income. Does that make sense? It cannot be a rental property. It cannot be an Airbnb. See, a lot of you guys is like having people think, having these influencers online tell you guys, oh yeah, if you got an Airbnb, you can rent, your business can rent from your Airbnb and then you don't have to pay taxes on it. That's not true, guys. For the Augusta Rule to be applicable, it has to be a non-revenue generating house, not your rental property. Are we clear? So put 1 in the chat, guys, if we are clear on this Augusta Rule. 1 in the chat if we are clear on this Augusta Rules. All of this stuff that these people telling you online, they've been lying. And I'm so afraid because, you know, they need the money for taxes to do what they're doing right now. And everybody is getting notices. Ask my staff. Over the past 2 weeks, every inquiry has been, IRS is auditing me. IRS is putting a levy on me. I received a lien letter. They're in the making. So, and I'm trying to tell you guys, yes, you can do all of these strategies, but you got to do it right. And you have to have your own accountant. You cannot take advice from these Instagram influencers. That's why I don't even consider myself an influencer. I'm the truth talker. That's why I'm the accountability accountant. I hold all you guys accountable to your mess. I even hold myself accountable every day. I don't even implement the Augusta Rule. And I can use my business and my home and have my staff come to my home. The Cohen Rule, I'm not using that because I do bookkeeping. Hire your child. Brent has already been hired in my company. I hired her 3 years ago. So the issue is, guys, every one of us, I don't care how much money you make, how much money your business make, guys. You need your own accountant so they can break down these rules for you. And so let me bring up this recent tax court case, guys, that connects the Augusta Rule, the Cohan Rule, the Mulligan Rule, all everything in one court case, and they lost. And now they're going to owe hundreds and hundreds and hundreds of thousands of dollars because they listened to a consultant. And guess what? When the IRS responded, they called them, when you're fighting the IRS, if you sue the IRS, they call the IRS the respondent, right? So when the IRS went to go and look for the person that provided these people the tax plan to do the Augusta Rule, Cohan Rule, and all that stuff, guess what? They couldn't even find the company. That's just like a lot of you people that's doing this ERC. When you guys get caught up in 2 to 3 years, the IRS is not going to be able to find that company because they're going to be long gone with your money. So guys, do me one favor, please. Hire your own accountant. If you don't want to work with me, I'm fine. I don't care. I don't need all of the headache from Instagram. But find your person. Find the accountant that you know that's on top of their stuff, know all the tax strategies, and it's going to make sure they maximize your taxes legally and tell you everything that you need to know. And they're not just baiting you on social media. Like, come on now, guys. This is marketing now. That's why I just post and I use memes and I try not to use catchy marketing because I refuse and I stopped this. Okay, honestly, guys, I used to do the marketing just like everybody else. But what I realized 5 years ago, and this is why I stopped, is that I can never give you guys the full truth in a 1-minute video. So I stopped giving you tips about home office deduction and all of those things and how to write off this and how to do that, because you need to speak with me one-on-one and I need to walk you through it. So I stopped it. But then 2020 came, all of these influencers came and took the bull by its horn and just started telling you guys strategies that you cannot implement on your own. And this tax court case that we're going to talk about today exactly shows you that. And these individuals were so crazy. These people even hired a professional. They had a CPA do their taxes. The mistake is because they skipped one of the steps. Give me a second, guys. I got to log back in. I got kicked out. I literally got kicked out. Okay, so let me read this thing on Instagram. He said, glad I'm still in class before I start my C Corp. I needed to hear this because they don't speak on taxes. Yes, they don't teach us none of that stuff, guys. And then truthfully, you know how they say learn about taxes in school? I do agree with us learning taxes in school, but learning taxes in school, it doesn't work. Because all it do is teaches you, well, you'll learn something. You'll learn about, let's say, the standard deduction, the basic things, right? But do you ever think you can really read the tax code if that's not your industry? And shouldn't we all actually really know the basics of the tax return? You shouldn't have to have school. The form is there. Guys, let me tell you how I learned. I am self-taught. Yes, my dad is an accountant, but I am self-taught. I read every form, every document. I don't take shortcuts. Okay. Let me show you guys. These are the content pieces that I'm about to create for you guys. You see my content? This is my content sheet. This is for my planner. So if you guys want to get organized like me, check out my planner. So this is my content sheets right here. So this is what I did this morning. So I'm going to talk about hiring your child. I don't need data on that because I know that like the back of my hand. Then I'm talking about the annual gift exclusion. So I go into detail and take good notes for everything. So I try not to cheat you guys and sugarcoat things just to get your guys' attention. Okay, so let's go into this tax court case, guys. I'm going to share my screen. And I'm not going to go over the tax case fully. I'm just going to give you guys some background and talk about the key points that I think is applicable to what we're talking about today. And the reason being is because this tax court case is 25 pages. And I do not have enough time to do that today. I actually have a meeting shortly. So we got to make this bittersweet and try to get as much done and learned in this short period of time. So guys, what was I talking about just now? Was it the Augusta Rule? Okay, so with the Augusta Rule, are we all on the same page with the Augusta Rule? Put one in the chat so I can know that I've touch bases on the Augusta Rule, and we are all on the same page, and you guys fully understand it. Put one in the chat. Okay, guys. So as you guys can see, this is the most recent tax court case. And again, if you want to see my screen, guys, head over to my YouTube channel, Folasade TV, so you guys can see my screen if you're on social and you cannot see it, okay? So as you guys can see, this is a recent tax court case. This was just filed, what, November 21st, 2023. So this is last week. No, what's today? Yeah, last week. Okay. All right. So let me give you some background because I've already read all 25 pages. Okay. So this couple, and let me stop sharing so you guys can see my face first, and then we'll go into detail, right? So this particular couple did everything that your online influencer told you guys to do. Set up a holding company, set up a management company, set up a trust, set up an S Corp, set up a C Corp. Every strategy, and it's so interesting that this case is being blown up now. Now, y'all know I'm right. They tell y'all to do all of that. Don't be lying. Y'all know I'm not lying. They tell you guys, set up this holding company, management company. Okay, so that's what this couple did, y'all. This couple went on ahead, set up a management company, this company, holding company, S Corp, C Corp, the works. Okay, so they end up getting the business going, making $800 and something thousand, and realize they're still an LLC, sole proprietorship, and they're going to be taxed heavily, which is okay. To say, oh my gosh, I don't want to stay at LLC to avoid taxes. That's okay, right? So what they did was they consulted with a company, guys, and I'm about to share my screen. They consulted with a company that I said earlier in our discussion that we can no longer find them people, right? They hired a company, and the company came up with, hold on, guys. Oh, y'all may have to bear with me while I'm trying to go through this, because I'm trying to pull it out so we don't have to search. Okay. All right, so I'm going to just read this paragraph to give you guys some background, okay? I'm not going to read the people's name, none of that stuff. Every time we do our tax court cases, guys, I'm not going to read these people's names. And then honestly, I can't even pronounce it. Okay, it says the petitioner received his PhD in chemistry on a date not established by the record. At all relevant times, he worked for a company as a salaried employee. So he had his 9 to 5, okay? As an executive for that company, the petitioner husband was responsible for increasing sales, developing new marketing ideas, and learning new areas of technology. During the years in issue, okay, that company paid him a salary between $154,000 and $159,000. Okay. In addition to working for that company, the husband also owned a sole proprietorship from 2006 to 2014, doing business as, I'm not going to say the company name. The husband identified his wife as the owner of that company, okay? I'm just giving you guys some information I remember when I read it, right? Okay. So now the company is called this. They earn commissions on sales to different companies. And guess what? They started to make money. And they started to implement tax strategies, which is perfectly legal, guys. So don't think implementing tax strategies is illegal. It is not, guys. It's not. I recommend it. But you have to do it right. So what they did was the company maintained a 401k. So they established a 401k. Okay. Then they went on ahead and took out $104,000 and contributed to the 401k profit sharing accounts. No problem with that. Okay. So then now we're here. The company started making really good money, guys. $800 and something thousand. Let me see if I can remember where that's at. Okay. Yep. Okay. I'm getting to it. Okay. So the company started making some really, really good money. Okay. So by 2014, the company was generating substantial income. Around that time, the petitioners engaged Capital Protection Services LLC to evaluate their organizational structure, to facilitate a succession plan, and reduce their tax exposure. They paid them $50,000. Okay. So for $50,000, that company provided them with a 183-page income tax plan. After interviewing and reviewing their financial information, it says CPS estimated that the petitioners, which is the couple, right, will have a tax rate of 37%, and told them, oh, well, if you implement everything in my tax plan, you would then have on average, a 9% tax rate, significantly lower, right? Who wouldn't jump on that? Pay $50,000 so you can have a large reduction in your tax liability, which may save you $300,000 to $400,000 a year. Anybody that paid the $50,000 quickly, right? And that's exactly what happened. So they paid them. So this company gave them a 183-page. This is a professional company. It is outlined and everything. Guess where the problem came into place, guys? Let me read this next sentence and then we're going to start digesting it. It says, in accordance with the above strategy that CPS advised, they advised the petitioners to convert that company to an S Corp, rent their residential properties to the S Corporation for business purposes at a reasonable rate per day. Okay. You hear that? And then they also said, oh, and this is where the Augusta Rule come into play. So it says, under the plan, the S Corporation will rent each of the petitioner's residential properties for a maximum of 14 days and deduct that expense on its income tax return. The petitioners, in turn, would exclude their corresponding rental income, which is legal. We learned that. You can do it. Guess where the problem come into play? They missed a step. And I don't want to read the whole thing. But what they did was they just took a rough estimate. Oh, I'm going to charge my business $3,000 per day to rent my house. I'm going to charge my business $2,500 a day to rent my house without any basis. Where did you get the number from? So if you guys are on YouTube or Facebook, you can see my screen. It says, here's the 4 properties. The daily rental amount was $2,500, $2,000, $2,000, $2,000. And then the days rented was all 14 each. In 1 year, it came up to be a $119,000 deduction. No, they didn't have investors. Okay, they had their own properties. These some rich people, which all of us can be. Okay, they had just had assets and stuff. No investor. Okay, and then the next year they did the same thing for 2015, 91,000 trying to use the Augusta Rule. 2016, same thing, 35,000 trying to use the Augusta Rule. And then last but not least, 2017, again, they attempted to do the Augusta Rule. Guess where the problem went at, guys? And I'm going to stop sharing really quickly. The problem wasn't that they used the Augusta Rule. That is a legitimate tax deduction. I mean, a legitimate tax strategy. The problem is that they missed a core step. In that income tax plan, it told them to get comparables, to figure out how to base their rental income. I mean, the rental amount. What they did was they just took the estimate that he gave them. So in the income tax plan, he said, oh, if we estimate $2,000 in rent, this will be your deduction. What they did, they took that same $2,000. They didn't get an appraisal done. They didn't do comparables. They didn't see what was the average rent in the area. They didn't. They didn't. So guess what? The IRS said, I got to charge up my phone, guys. Give me a second. When they got audited, the IRS didn't accept it. They disallowed it in the audit. And so those people said, okay, well, since you disallowed it in the audit. So remember I told you guys, they don't have to accept that Cohen rule. They don't have to accept your deductions in an audit. That's why you have to go to tax court. So they didn't accept it. And then they went to tax court. And guess what? The tax court also agreed with the IRS and declined the Cohen rule because he was trying to use the Milligan rule to implement the Cohen rule, and they threw out the full Augusta Rule tax strategy. So I got to zoom down a little bit, guys, to do it. In addition to them throwing out the Augusta Rule and not allowing them to implement the Cohen rule, guess what? They also disallowed a lot of other expenses. This marketing fee that you guys can see on my screen that they thought that they can pay to their C Corp and get off their books so they don't have to pay taxes, they disallowed that deduction. And in the end, guess what the IRS said? All of those were sham companies, and they didn't even accept those returns. And so why am I bringing this to you guys' attention today? This particular tax court case have debunked every tax strategy that all of these so-called gurus have been using to lure you guys in to buy their coaching program. And as you guys can see, this particular person ended up hiring a professional. And as I go down in the tax court case, you're going to see they hired a CPA as well to file their taxes. That doesn't mean a thing. They didn't do it right. You cannot skip steps. This is why I tell you guys, hire your own accountant. Do your bookkeeping. Keep proper records, but you don't want to listen to Folasade. You think what I say is I just don't want you guys to take the tax strategy. No, I want you to take them all. But what I don't want to do is have you in situations like this. And so guess what? Now they took that person's advice, didn't do the full steps. These people are going to owe millions of dollars in taxes now. Millions of dollars in taxes. Exactly. They were moving too fast. They're going to owe millions of dollars in taxes. So let me go down where I can show you guys what the IRS, well, the tax court, this is not even the IRS. The tax court threw out all of those businesses. Okay, let me see if I can find it. What page is this? Hold on, what page is this? What page am I on? Why is it not showing me at the top? Hold on, guys. Okay, so let me just read this. It says, after deducting its reported expenses, KJJ reported ordinary business income of $10,945 and blah. I'm not going to read all of the years, okay? Petitioners reported those amounts on their Schedule E, okay? Supplemental income and loss for the years in issue. Petitioners also reported their rental income from KJJ on their Schedule E, but treated those amounts as excludable. Remember, guys, I told you that we cannot have a rental property, a business activity, and have it qualify for the Augusta Rule. You cannot. But these are what these influencers are telling you guys. Oh, if you got an Airbnb, you can rent to your business. That's what they're telling you guys. Okay. So during the examination, right? I'm about to read a little bit of this, okay? It says in 2017, the Internal Revenue Service selected petitioners, KJJ, JYJ returns for examination and assigned the case to a revenue agent. With respect to KJJ forms 1120S, so that means they filed an S Corp, because remember in their tax plan, they said convert to S Corp. Remember, that's the saving grace. Everybody convert to an S Corp. It don't work like that. I'm about to read it again. It says, with respects to KJJ forms 1120S, the IRS agent fully disallowed the S corporation rent deduction. So remember, they were paying the other company to rent out the home. The other company was a rental property. The IRS said, oh, no, 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 and disallowed it. Then it says of those items, only KJJ reporting marketing fees and travel expenses remain an issue. So right now, as of this page in the case, they already then threw out the Cohan rule. The Augusta rule. They already threw that out. Now they're saying they're about to figure out these marketing fees and these travel expenses. And remember, guys, we learned earlier in our live stream that the Cohan rule cannot be utilized for travel expenses. So it says in a civil penalty approval form dated October 31st, 2018, R.A. Vickers made an initial determination to assert accuracy-related penalties. Okay, so basically they're saying that once the IRS agents started throwing out stuff, they updated the penalties. Okay? They updated the penalties. And then with all of the penalties being adjusted and updated, they tried to fight that as well. So let me go ahead on all the way down to the last part of this, and then we can be closing out soon. I'm not hoping that you guys have learned a lot from today. Sandra said people have to learn to do this the right way. Exactly. Okay, guys, hold on. Oh, Lord, did I forget what page I was on? Okay, there we go. I got so many tabs up, guys. Alrighty, guys, so we're getting close. Let me pull up the main key points of this case, and then we're done. Oh, I forgot. With my daggone glasses, guys. And I see why I got my glasses, y'all. I got my new glasses. It shouldn't have no glare either. I think I need to go get my glasses and try to see if I can see, because I am so struggling. They probably wasn't. Hey, Valisha. They probably wasn't in business for 3 to 5 years that instantly showed red flags. So, no, they wasn't. They wasn't. Not those new structures. Nope, they wasn't. But I don't think that was the red flag. I think, honestly, what was the red flag was that it was so. Remember, when you guys are paying money through different businesses and things like that, you have to issue 1099s and things like that. So I think they just started to track things. And remember that company ended up making $800 and something thousand, but the net was only 10 grand. So the IRS is like, holy cow, okay. So you made $890,000 and you only profited 10 grand, and you only profited 10,000, 50,000, and it just don't seem consistent. So I think it was just a collective of issues. And then the expenses were probably exaggerated in different areas. And remember, guys, if you've been watching me for a while, remember a consistent return reduces your chances of being audited. And guys, just to give you an update, so my book is finally launched, Audit Proof. I've been having issues with the daggone cover, y'all. But look, so if you want to learn how to write off everything, you need to invest in my book, Audit Proof, guys. Invest in my book, Audit Proof. Is 139 pages. You also got a resource page where I give you guys logs, documents. Okay, like for example, in the back of the book, it says, what medical expenses can you include in your itemized deductions? And I guarantee you guys, some of you didn't even know that your birth control pills can be written off as an itemized deductions. Some of you guys didn't even know that abortion that you got this year, the year before, and the year before could have been also written off on your taxes. So that's in the back of the book. Throughout the book, I'm giving you guys strategy from all the audits and things that I've done and clients that I've represented over years, what you guys need to do to write off everything. Let me see if I can pull out a page. Hold on. And I might need to do like a little silent read, but not all the pages. Let me see what I want to do. All right, which I want to pull out. Let me see Let me do one of my pro tips because I know y'all don't know some of the pro tips. Let me give you a pro tip. Okay. I just saw one. And then I'm going to go back to this, but I wanted to show you guys my book. Okay, so look, in my book is a whole little section that says how to audit proof your travel. Here's the exact steps of what you guys need to do to write off your travel. Step 1, I'm not going to tell you what to do. Get the book. Step 2, I'm not going to tell you what to do. Get the book. Step 3, I'm not going to tell you what to do. Get the book. Step 4, yeah. Okay, but let me read your pro tip, guys. And I do that for how to audit proof your travel, your auto and car expenses, your charitable donations, your home office deductions. I also have what triggers an IRS audit and how to reduce it. Guys, the book is fire. And it's not daunting either. Oh, the difference between your hobby versus your business. But let me read a pro tip and then I'm going to get back to the topic, okay? Hold on. I just saw one. Is that a pro tip? Okay, let me give you an afterthought. Which section is this? What chapter is this? Okay, so chapter 2, audit proof your expenses, right? I'm going to give you an afterthought after the chapter. It says each expense must be documented separately, including a clear explanation of why the expense was incurred, when and where it was purchased, and how it relates to your business. Simply having a receipt is not enough evidence, and that's in my book, Audit Proof. So right off the bat, just that one little afterthought, you already know that each expense needs to be properly documented. Then I tell you guys how to write off everything, literally. Let me go to the last section of that. Okay, so hair and nails. I tell you guys how to write that off legally, okay? Your regular lunches, but you can't really do regular lunches. Find out how to do it in the book. And then I tell you guys the whole strategy on how to make everything a write-off. Okay, so you guys want to invest in my book, Audit Proof, 11 Steps to Audit Proof Your Business and Write Off Everything. And I didn't leave nothing on the table. My team was like, Miss Fola, you need to charge $50 for this. I'm like, no, I can't charge $50 for that. Okay, guys, sorry about that. My brief little advertisement, guys. But definitely you guys want to go and invest in Audit Proof. It will never go out of style. Every strategy that I give you guys, it will never change. Is if you implement those, you'll be good if you were to get audited, examined, and also trying to make sure you don't miss deductions as well. Okay, so check out my book, my first book, y'all. I'm so excited. Audit Proof. Okay. All right, so let me go back. Thank you, Alicia. Okay, give me a second. Okay, give me a second, guys. Let me go and find. Okay, I think this is it. Did I find it? Did I find it? Mulligan. Hold on, guys. Hold on, y'all. I just want to connect the dots between the Augusta Rule and the Cohan Rule so you guys can see what I was explaining initially, okay? And we can be on the same page that bookkeeping is really the biggest tax strategy. Don't let nobody ever tell you. Yes, if you go to my link tree, it should be the first link in my link tree. And thank you guys for everybody that have purchased Audit Proof. I'm so excited. It's going to change the game because you guys are not going to have to it takes the guesswork out of it. You'll know exactly what you need to do. Okay, so I think we got to go into this a little bit into it. Okay, guys. So I'm gonna have to read a couple of sections. Okay, yeah, I'm gonna have to read a couple of sections. Okay, it says the respondent, which is the IRS. Okay, not the IRS may not always be the respondent. The IRS is the respondent if you sue the IRS. Okay, so they responded to your case. So it says respondent does not appear to dispute the classification, which is their kid's name, as employees, at least not for 2015 and 2016 and 2017. So these people hired their child. So this is another tax strategy that we talked about. These people hired their child. The IRS said, okay, I agree with you that you hired your child legally in 2015, 2016, and 2017, but not 2014. It says, rather, respondent disputes the timing of their employment, asserting that it did not commence in 2014. In support of its contention, respondent cites petitioner's failure to file Forms W-2. How many of you have heard these people trying to tell you guys to hire your child? You don't need no paperwork. And as you guys can see right here, right now, this tax court case said, these people not your real employees. You didn't issue them no W-2s. So how are you going to hire your child, pay employees, and say they really employees without issuing W-2s? But these gurus telling you, oh yeah, you don't need to have no paperwork. I hope you guys see it for yourself now. They lying to you guys. They're lying, and it's getting on my nerves. Okay, so it says, to be sure, the failure to file information returns may undermine the assertion of a bona fide employer-employee relationship. So the moment that you guys do not issue W-2s, it's already impeding on that. Is that your real employee? In this case, however, the petitioner's husband's credible testimony is supported by contemporaneous evidence in the trial record. The plan, which was prepared in 2014, states you have 2 children. The children work in your business. Thus, under that particular circumstance of this case, we find it more likely than not that the children were petitioner's employees in 2014. Respondent does not dispute petitioner's pension and profit sharing deduction on any ground besides what it was. Okay, so now travel expenses. On their 2014 Schedule C, petitioners claim a deduction of $68,000 for travel. Respondents, the IRS, argues that the petitioners have not substantiated these reported expenses. And remember, guys, I told you that this doesn't fall under the Cohen rule. It says strict substantiation requirements of Section 274D. So Section 274D are expenses that require additional substantiation, such as auto expenses, travel, gifts. They go into more detail of how those expenses are supposed to be disallowed. It says, so don't you say, do we have to authenticate our child's birth certificate? No, you don't have to do that. So under Section 274D, the taxpayers generally must substantiate either by adequate records or by sufficient evidence corroborating the taxpayer's own statement. Number 1, the amount of the expense. Number 2, the time and place the expense was incurred. And number 3, the business purpose of the expense. And 4, in the case of entertainment or gift expense, the business relationship for the taxpayer. Guys, all of everything that they're saying, what you got to do is in my book, Audit Proof. Every step that they said that you guys need to do to substantiate your expenses is in my book, Audit Proof. Every step, step 1, step 2, step 3, and for each deduction as well, okay? So you guys don't have to guess at this stuff no more. I've already released the blueprint. You got it step by step in my book. Check it out. You will not be disappointed, okay? It says, and 4, in the case of, okay, I read that one. For listed property, expenses taxpayer must establish the amount of business use. Substantiation by adequate records requires the taxpayer to maintain an account book. They don't want to say bookkeeping, guys, but that's what they mean. A diary, a log, something, okay? And it needs to be contemporaneous, meaning it needs to be updated as you're going. And we talk about that in the book as well. To support their deduction for travel expenses, the petitioners submitted reconstructions of travel logs or odometer readings. However, the record does not contain any documentary evidence or other direct or circumstantial evidence of the time, location, and business purpose. On my mileage log, I give you all of that as well. All of the logs. Where's my logs? I give you every log in the book. Here y'all logs in the book. And I didn't even think to even, yeah, I'm excited. I'm pressed now. Y'all got the blueprint, so y'all good. I feel like I did my part. I don't care if I don't do nothing else for y'all ever in the world. Y'all got my book, audit proof. You should be good forever. Okay. All right, let me get back. Okay, so then now let's talk about the marketing fees. So they said that they couldn't substantiate the travel, and now the marketing fees. Now, remember, all of these online influencers keep telling you guys, oh, just set up a holding company, a management company, a this, a that. I'm not against it, but it got to be the right way, guys. You can't do it like these people. Okay, so these companies, and I'm going to read it. It says, for the years in issue, KJJ claimed deductions for marketing fees in accordance with the plan. Having fully disallowed those deductions, the IRS contends that the marketing fees were not ordinary and necessary under Section 162. See, the IRS said that marketing expenses, and we talk about that as well. I talk about that as well in my book. Okay, that your expenses have to be ordinary and necessary according to Section 162, and I explain in detail. And they're saying, and why I'm getting excited is that this is why tracking your stuff, guys, and doing things the right way is required. Because if it's a legitimate marketing expense, then it shouldn't be thrown out. It shouldn't be disallowed. But guess what? Because we're not doing things right, we want to take shortcuts, we want to cheat the system and pay little taxes illegally, then this is what's happening. Okay, so I'm going to skip some part. It says, having carefully reviewed the record, we are doubtful that the marketing fees were ordinary and necessary. The creation of JYJ was one of the tax reduction strategies CPS had recommended in the plan. Pursuant thereto, KJJ made large annual payments to JYJ, of which petitioners were shareholders and directors. JYJ did not make any marketing expenditures for KJJ as CPS has suggested. It would in the plan, nor did JYJ host meetings on KJJ's behalf or kept initial board minutes. Nevertheless, KJJ paid large yearly sums to JYJ, which in turn used those sums to pay personal expenses for the family. So they transferred money over to this business saying it's for marketing fees. That business got the money and then started paying personal expenses from it. We just talked about this in our video when I talked about the trust, that you guys are setting up these trusts, putting all of your businesses, all of your assets in the trust, and then you're trying to pay personal expenses from the trust account. You cannot do that. So it says, in the light of these facts, we find it more likely than not that JYJ did not provide ordinary and necessary marketing services to KJJ. It says, acknowledging that JYJ did not provide traditional marketing services, the petitioners nevertheless contend that the fees were ordinary and necessary for the purposes of risk mitigation. At trial, the petitioner husband testified that he used JYJ to develop new ideas, many of which would fail. According to petitioner's husband, JYJ shielded KJJ from the reputational risk of such failures. Petitioner's husband testified that once an idea proved valuable, KJJ will market it to potential users. Although we found petitioner's husband credible, he did not explain the marketing fees, how the marketing fees were determined. It is also unclear from the record whether JYJ developed any ideas that warranted KJJ payments of large annual marketing fees. So guys, what they're saying in short is that, yes, they were paying KJJ and JJJ and KWay, right? But was it for legitimate marketing services? An invoice wasn't received. 1099s wasn't being issued. It's a lot of what they're saying. It also says here, it is also unclear from the record whether JYJ developed any ideas that warranted KJJ's payment of large annual payments. The invoices in the record are vague, stating only that JYJ provided marketing and sales promotion. So here we go. Marketing services thrown out. Travel services thrown out. The Augusta Rule thrown out. Okay, guys, I have to move a little faster. So let me try to go to the last part where the IRS said, we're not accepting no estimates. We're not accepting the Cohen rule. We're not accepting nothing. Okay, let me talk about this travel. It says on its form 1120S, KJJ deducted $17,000, $11,000, $23,000 respectively. The respondent contends that the petitioners have not substantiated the reported travel expenses. Okay. So that was thrown out. And they got additional penalties for it. So let's say, for example, your travel expenses were supposed to be $10,000, but you claim $100,000. Since it's over 20%, you will incur the inaccuracy penalty. Okay. All right, I'm almost there. I'm on the last few pages. Okay. Hold on. I'm trying to find it. Oh, and then last thing but not least, this is why I don't play games with you guys when it comes down to me having my processes in place in my company, because they try to blame the CPA. Oh, well, we gave the CPA everything. And the IRS said, oh, hell no. You didn't give the CPA everything. You didn't tell them everything. Okay, so let me read this last part of it, and then I'm going to allow you guys to ask me any questions. I'm going to read the other part. Okay, so the petitioners have not established that they reasonably relied on Mr. Walker, which is the CPA that filed their taxes, to be sure petitioners provided Mr. Walker information about the organizational changes to their business as contemplated by the plan. However, the record does not establish that the petitioners alerted Mr. Walker to the nature of JYJ's marketing services, which deviated from those described in the plan. Nor does the record clearly establish what information, if any, petitioners provided Mr. Walker about their travel expenses. Because petitioners have failed to show that they provided Mr. Walker, they were trying to blame the CPA, Mr. Walker, all the relevant information, we cannot conclude that their reliance on him was reasonable. Accordingly, and assuming the Rule 155 calculation confirms substantial understatements of income tax, we sustain respondents' determinations of accuracy-related penalties as reflected in the SNODs. However, we do not sustain respondents' determination regarding the proportionate increases to the penalties as reflected in the amended and second amended answers. In reaching our findings, in reaching our holdings hereon, we have considered all arguments made, and to the extent not mentioned above, we conclude them to be moot, irrelevant, and without merit. To reflect the foregoing, an appropriate order will be issued and decision will be entered. Basically, the case was thrown out, guys. Let me see if I can see where they had the Cohen rule. Remember, I was looking for that. I'm going to have to make sure I have my glasses by me next time, guys. So they lost the case. They lost the case. They lost the case. You have to substantiate these expenses that these so-called gurus are telling you guys to deduct. You cannot rely and think that, oh, telling the IRS agent and the tax court that you relied on a 60-second YouTube video or Instagram short or something that's going to fly in tax court. They even had the CPA prepare their return, and the tax court said, oh, no, you didn't rely on him. You didn't give him everything. So saying that you got the information from a CPA or Instagram, it's not going to fly either, guys. Bookkeeping, proper record keeping is the key. Yes, knowing about the Cohan rule is good, but don't rely on estimates. And number one, the reason why I don't like for you to rely on estimates, guys, is because that means we're leaving money on the table. Let's say, for example, your travel expenses. No, let's say, for example, your rent expense is really $30,000. But because you didn't do your bookkeeping, you don't have proper records, you end up only claiming $15,000. So that means we left money on the table. Either you paid more taxes or your refund was lower just because you didn't keep the proper records. The Augusta Rule is beautiful, but it needs to be done right. It cannot be done on revenue generating assets. It cannot be your Airbnb that you're renting to your other business. It cannot be a rental property that you rent to another business. It has to be your primary residence that is not revenue generating. The reason why, that's why it's called de minimis. The reason why we're able to write off the Augusta Rule is because based on a de minimis amount, they're saying that it's small. It shouldn't have that much of an impact. But as you can see from this tax court case, they try to deduct $91,000. The Augusta Rule only works because they're considering it an amount that won't have a substantial impact on your tax liability. It's de minimis. It's a small amount. But then people, and a lot of you, didn't do your part. And you're claiming an exorbitant amount of rent from your business to your personal, and you're not paying taxes on it just like they did. And as you guys can see, they did it for years consecutively. And the IRS went back. So that also confirms what I've been telling you guys, that the IRS will go back 3 years if they want to. If they see that, this same expense is being carried to every year back, they can go back. Okay, guys, so I think I rocked this thing out. How much time? Oh, gosh, a whole hour, and I didn't break out the Instagram. Oh, my gosh, Grace, Ella, I am so sorry, guys. I normally stop the video in between when I'm going to different topics. Oh, my God. Okay, all right, guys, so do you have any questions at all? Any questions? I got like 10 minutes before. Well, let me go and open up the door for the kids. You guys have 10 minutes to pick my brain, and then I have to get off because I have a 3:30 meeting. So let me go open the door for the kids, and then post your questions if you have any, and then we'll go from there. So I think I'm going to stop the Instagram just so the Q&A can be separate. Is that okay? So let me stop the Instagram and then let the Q&A be separate, okay? All right, guys. Oh, yeah. Okay, give me a second, guys. Augusta Rule. All right, so let me put on some music really quick, and then I'm gonna ask for Q&A. Okay, give me a second, guys. Let me just do a little break, and then we're gonna do Q&A. And I need to open the door for the kids. Okay, give me a second, guys. Where is my brakes? I don't have no brakes. I don't have no brakes, guys, so we gotta use this. right, guys. So I want to give you guys a few minutes before my 3:30 meeting to ask me any questions regarding today's content, today's live stream. Any questions regarding the Augusta Rule? Any question regarding the Cohan Rule? Any questions about hiring your child? Any questions? What else we talked about? Section 162, ordinary and necessary business expenses. Do you guys have any questions at all? Let me know, because I can log out and go about my business. And then I am going to go live tonight, guys. I don't even know what the topic is for the show yet. I got to review my notes. But any questions, guys? The floor is yours. Any questions? If not, then I'm going to go. I don't want to waste my time now. Okay, guys, so you don't have any questions. This was your opportunity to pick my brain. If you guys have any questions or concerns, just message me on Instagram or be available during my next live stream to ask those questions. If you guys want to work with me independently and you want me to be your accountant, just go to my link tree. You'll see the links in my link tree, so you can get on my calendar so I can talk with you and to see whether or not me and my team will be a good fit to serve you. If you guys want to know how to audit proof your expenses and write off everything, guys, go and check out my newly released book, Audit Proof, 11 Steps. All right. 11 steps to audit proof your business and write off everything. Okay. Check that out. We just posed a question, Prince. Prince, I got so many questions, don't know where to start. Just post your questions. You got 10 minutes, okay? Post your questions, guys. And let me tell you guys, for all of you that are very new to me, I've been live streaming since, what was the first software before Periscope? The first app? Dat something? It was an app called Dat something. Then we all went to Periscope. This was around 2014, 2013. You know, we were live streaming at that time. So I've been live streaming since then. The only reason why a lot of you are just finding me now is because I was shadow banned and banned for the past 2.5 years. Every time me and my team will come up with a new concept, all of y'all influencers will report my page. Okay, so when I released my Hire Your Child class in early 2020, they reported my page. I've been shadow banned since 2020. Before that, I was shadow banned prior to that as well. So you guys are just seeing me, and I'm lucky enough, and I just say thank you guys for all of my followers and stuff, for me to be almost at 25,000 followers. Guys, if I wasn't shadow banned for 3 years, I would be at hundreds of thousands of followers. And then a lot of these so-called accountants and CPAs that's spewing this false information just to pick y'all, get y'all bucks, and all of these coaches just want you guys to invest in y'all programs. A lot of that wouldn't have happened if I wasn't shadow banned, because you would have heard the truth. But if they are keeping the truth from you, you're investing in whatever's out there. Okay. So guys, I'm here. I may not be live streaming like I used to, because I used to live stream 2 to 3 times a day, at least once a day at a minimum. I will never give you guys that, because I have so much videos that if you guys go watch it, nobody is teaching you nothing new. I have content from 2014 on my Facebook page, from every tax plan, everything. Everything. Oh yeah, they banned me when I started teaching audit proof. When I taught my class of audit proof, they banned me. And then they also banned me when I did Hire Your Child. Yeah. Okay. So Pierre says, I'm just getting started. I haven't done any taxes in 3 years because I just started my barbering business. I have no LLC or C Corp, but I'm learning about a 1099. Okay. All righty. So let's first of all put this in perspective. Remember, I don't know if you guys saw my video about 2 weeks ago, guys, when I said that do not fall for these online influencers telling you guys that you don't have to file your business income and your business expenses. I gave you guys multiple scenarios in which you have to, okay? If your business is a corporation, S Corp, or partnership, guys, you have to file the return regardless of if you make money or spend money. Yes, I have a lot of content on YouTube, a lot of content. Number one. However, for a sole proprietor, just like you, 1099, independent contractor, don't have a LLC, your benchmark is net $400. So let's say, for example, you made $10,000 in your barbering business and your expenses was $9,500. So that means you only have a net profit of $500. You have to file your tax return. So in your case, you may have been required to file and didn't. So if I were you, I would go back, pull all of my income, total that, pull all of my expenses and total that. If the income is $400 or more above your expenses, you need to file that tax return. Okay? So guys, my family is here. You about to hear the dog, and then the kids are about to come and say, hi. Hi. How was your day? It's amazing. Good. Love you. Okay. So the kids are just in. So I'm about to be on my mommy thing and get ready for my 3:30 meeting. So guys, I love you guys. Okay. Any advice? Okay. So PSA. Any advice for me getting a fresh start? Yes. So I recommend every one of you guys, especially if you want a fresh start, let's start fresh by doing our bookkeeping. I know you haven't heard many influencers tell you to do your bookkeeping because it's not beautiful, right? It's I don't want to say it is daunting, right? But bookkeeping is your biggest tax strategy. It is the biggest thing. It's one of the most valuable things that your business will ever need. It shows you how much money you're making, how much money you're keeping, where your money is going, what you can do more. So many questions could be answered. So I would just say, to get that real fresh start for all of you new business owners, can we start bookkeeping in 2024? The Augusta Rule will never save you as much money. Well, let me say this. Taking the home office deduction or taking the depreciation, what they say, section 179 deduction, none of those will give you the biggest deduction that your bookkeeping will give you, because your bookkeeping guarantees that you've totaled all of your income and all of your expenses, guys. If you guys don't do that, then what's the purpose of a tax strategy? The tax strategy is supposed to help you save even more. We're not supposed to rely on tax strategies. We rely on our record keeping, our bookkeeping, and things like that. And then you talk with your accountant, they're like, oh, okay, so I see you got this expense. I see you got this. You might be able to deduct this. You might be able to do this strategy. Oh, did you think about this? Did you start a 401k for your family? Did you get a Roth? Did you do this? Did you set up a traditional IRA and all of this stuff? So the strategies would then come at that point. Okay, so you say, yes, I have records of my booth rent and my products. I've been recording my travel. Yeah, okay, perfect. So what you want to do is maybe use QuickBooks Self-Employed, okay? Go ahead on and use QuickBooks Self-Employed and start there. I will also say go back for those years that you didn't file the return and make sure that the income is not above $400 profit. And then once you do that, right, just keep track of every expense. On the personal level, I recommend you guys download mint.com. It's a software by Intuit that accumulates your business, your personal expenses and things like that. So in the end, you have your QuickBooks managing your business, and then you have your Mint managing your personal. And then if you look at the two, you can really make some good decisions, okay? All right, guys. I will see you guys tonight. Let me see what the topic is. I don't have time for that. I will see you guys tonight. I love you guys so much. I hope that today's live stream was extremely beneficial to you. I still will have little videos chopped out because I still got to record all of these things because we didn't even talk about these. I only talked about 2 of them on here. So I still got to record that. And so, yeah, guys, I love you guys. Don't forget to purchase my book, Audit Proof, 11 Steps to... You need it, okay? So, guys, I love you guys so much. Invest in the book. Do what's there, and you guys will be fine. And don't take shortcuts. Please, it's going to hurt us in the long run. I love you guys so much. See you. Bye.